Central banks storm. We are getting ready for a crazy week with critical economic data and central banks meetings in the UK, US, Swiss and Eurozone. This week will tell us how this year will be end and how we are going to start 2023. Market participants will be interested chiefly in their economic outlooks and predictions of interest rate hike trend in the next meetings. So, the focus will be on their interest rate decisions and economic perspectives. Let's review the most important events and the news in the week ahead with me, Ahura, and Extra Markets. Number 1. UK data. Besides the central banks meetings in UK, we will also have the many other essential data to be watched. Gross domestic products, industrial and manufacturing production, and trade balance data will be out on Monday. Labor market data on Tuesday, inflation numbers on Wednesday, and purchasing manager index on Friday. Inflation is expected to increase less than a month ago with 1.7% in November, which also brings the annual inflation down to 10.7%. The risk is that inflation expectations become entrenched and it can affect the economic and consumers' behaviors. Number 2. US inflation. A day before FOMC meeting, inflation numbers will be out and is expected to ease to a 0.2% monthly gain, translating to a 7.2% annual pace in November. Currently, the main headline inflation driver is the service sector. Increasing prices in the service sector have offset this inflation for goods and kept the Fed caution in its inflation outlook. While we expect core goods inflation fell 0.2% in November, core service inflation likely rose by 0.6%. That will be the last significant indicator that FOMC members will receive before their 2 days meetings on Tuesday and Wednesday. Number 3. Fed meeting and press conference. FOMC's 2 days meeting will start on Tuesday and we will have the announcement and Fed Powell's press conference on Wednesday. Since a 50 basis point rate hike to 4.75% is widely expected and already priced in, the focus will be on Chair Powell's press conference, January rate hike forecast, and especially the dot plots. Dot plots will tell us what could be the maximum level of raise and the possible time to start the reduction in interest rates. In general, despite the smaller rate hike, the inflation expectations and dot plots can hold the pressures on the US stock markets and lift the US dollar. Number 4. China retail sales and industrial output. Since Chinese economic activities have been slowing in recent months, the outlook for November activities also is weak. Industrial output in November is expected to slow to 3.7% from 5% in October, while the consensus forecast for retail sales to decline to 3.9% annually. This expected data can hold pressures on the Chinese yuan. Government retreat on anti-COVID restrictions may not affect November data much, but we can expect some recovery in December. Number 5. Bank of England policy decision. The last meeting's announcement shows that some monetary policy committee members support less hawkish decisions. Therefore, we expect a lower rate hike compared to previous months by only 50 basis points to 3.50%. While some analysts believe in one more rate hike by only 25 basis points to 3.75% as a peak policy rate for the current cycle, inflation will still be the main game changer. On the other hand, earlier forecasts for a protracted economic recession can be the reason to slow down the rate hikes or even start to slightly rate cut to support the recovery. The expected decision can put the sterling in a weaker position against its crosses. And finally, number 6. European Central Bank policy decision. The central bank that will have the last monetary policy meeting among developed economies this year is the European Central Bank, which will also be held on Thursday, similar to the meetings of BOE and SNB. In a process almost identical to other central banks, we expect that after second straight 75 basis increase in its deposit rate to 1.50%, ECB will also ease its pace of rate hike by only 50 basis points to raise its deposit rate to 2%. With a slightly slowing inflation to 10%, another topic that will likely be discussed is reducing ECB's balance sheet size or quantitative tightening. Expected policies cannot help the European stock markets but can reduce the pressures. Thanks for watching this video and hope it's going to be an amazing week for all of you guys.